So the first interest rate is fixed rates. For a period of 2, 3, 5, 7 or even 10 years, whatever is relevant for you, your payment will not change. You will have a charge if you were to pay that mortgage off whilst you're in the fixed rate period. They do give you the flexibility to overpay generally. That's up to 10% of whatever your starting year balance is. So in year one of a £100,000 mortgage, you can overpay £10,000 penalty free. If starting year two, your mortgage is £88,000, then you could overpay £8,800 without suffering any penalty. Once you reach the end of your fixed rate period, i.e. 2, 3, 7, 10 years, you will then be able to reshop the market and find another deal that suits you at that point in time. And it is good to review the market, speak to a mortgage broker. Tracker rates. You're going to get a tracker at, for example, 1% above the base rate. As the base rate increases, so does your rate. As the base rate decreases, so does your interest rate. So you find that it's a little bit more risky to do that rather than having a fixed rate, because there might be ups and downs. But the one thing that flex trackers do offer is a little bit more options. So you generally find they're a little bit more flexible, but it's all about assessing what's right for you at the time, seeing what the interest rates are, because if you've got a fixed rate at 2% and a tracker rate at 2%, in the current climate, the rates are realistically only going in one direction, and that's upwards. So we would assess that for you to make sure that's right for your circumstances. The next one that we're looking at would be the discounted rate. Disadvantage, first of all, I'm starting with on this one, is it's a discount off of the lender's standard variable rate. Now, who decides that? Each and every single different bank. So they will choose what they want to do with their standard variable. They will choose to rise and to increase it and decrease it as they see fit. At least with a tracker, every first Thursday of the month, the Bank of England release what they've done in terms of increase or decrease. So you know what's going on, you know if your payment's going up or going down or staying the same. With a discount, it's specific to every lender. They all offer different standard variables, but they might say, our standard variable is 5%, you can have a 2% discount, meaning you're paying 3%. As they reduce or increase, your payment does the same. Offset mortgages are quite unique in the marketplace. They enable you to be able to link your savings to your mortgage. Now, they also give you a current account that goes alongside that mortgage, so you could offset your salary. So for example, if you get £3,000 paid to you on a monthly basis, for as long as that money sits in that account, the offsetting method of that against your mortgage means that it's not growing in interest, but the interest that it would have earned can either be used to reduce your monthly payment or be added on top as an overpayment, because any overpayments that you make reduce the amount of time that you've got left to pay it. So you pay it off much, much quicker in essence. Bank of England base rate. It is the rate at which the banks set their standard variable rate. So 0.25%. The banks then turn around and say the standard rate of which we're going to lend money is 5% for argument's sake. That is the two main rates that you will see. What will happen then is a lender will give you a deal for a period of time, and that is your fixed, your tracker, your discount, your capped rates. An early repayment charge is something that you would have to pay if you wanted to pay your mortgage off whilst you're on your fixed tracker or your deal period. Once that deal period ends, after 2, 3, 5, 7, 10 years, whatever it might well be, you're then back onto the standard variable rate. There's lots of options that are available to you outside of having an early repayment charge.